Is the AI bubble real? How to protect yourself with options. Many investors are wondering whether the market is currently experiencing an AI bubble as a result of the rapid increase in the value of AI stocks, and if this is the case, what they can do to protect themselves. Because the stock valuations of businesses operating in the artificial intelligence area are soaring to historic highs, the issue arises as to whether or not these valuations are sustainable or whether or not we are on the verge of an inevitable correction. Artificial intelligence has demonstrated the capacity to change a wide range of industries. To protect your gains and negotiate this difficult terrain, here's how you may use options methods to hedge your portfolio and guide you through the process. Do we exist in an artificial intelligence bubble? The phenomenon known as a bubble takes place when the values of stocks rise above their true value. This phenomenon is frequently fueled by hype or an overly optimistic market sentiment. Because investors are anticipating a future that will be dominated by AI-driven innovation, the stock prices of firms such as Nvidia and Alphabet, as well as smaller startups focused on artificial intelligence, have increased. Some industry professionals, however, are warning that such valuations might not be sustainable if artificial intelligence development slows down, regulatory obstacles materialize, or excitement outpaces actual revenue growth. Among the indicators that point to the possibility of a bubble are sky-high valuations. The price-to-earnings ratios of certain artificial intelligence stocks are significantly higher than the average, and in some cases even exceed the standard range for the technology industry. Many smaller companies with low earnings are experiencing elevated stock values, which are mostly driven by hopes rather than fundamentals. Speculative investments are a term that describes these types of investments. Intense media hype. News cycles that place a heavy emphasis on artificial intelligence have the potential to generate investor excitement, which can contribute to market overvaluation. While it is undeniable that artificial intelligence is causing a revolution in various industries, it is essential to approach investments with prudence and be prepared for the possibility of a decline. In this aspect, options can end up being quite useful. Using option strategies to protect yourself from potential dangers. You can reduce the amount of possible losses you could incur if AI stocks experience a downturn by using options. Take into consideration the following various choices and strategies. Puts that offer protection. One of the most straightforward methods for protecting oneself against the possibility of an artificial intelligence bubble bursting is to use a protective put. When you purchase a put option on an AI stock that you already own, you are investing in the right to sell the stock at a predetermined price, which is referred to as the strike price, before the expiration of the option. Consequently, this reduces the chance of a loss while also enabling you to profit from any additional upward movement. If you are a shareholder in Nvidia, for instance, you can purchase a put option with a strike price that is relatively near to the current value of the stock on the market. The put option will increase in value if the stock price falls below the strike price. This will compensate for some or all of the losses that you have incurred in your shares. When to use protective puts? Protective puts are an excellent choice if you suspect that an A stock could see a decline but are not yet prepared to sell your shares. An illustration of this would be the purchase of a put option with a strike price of $400 and a specific expiration date if Nvidia is currently trading at $420. If the price of Nvidia declines dramatically, the put will compensate for some of the losses you incurred. Calls that are covered. One method of generating defensive income is known as covered calls, which involves selling a call option on shares that you already hold. By taking this technique, you will be able to generate premium income, which can serve as a buffer against the possibility of AI stock prices falling. Even though it limits the potential for higher returns, it offers a steady source of income that can help mitigate risk in a volatile market. You own shares of an artificial intelligence stock, for example, Microsoft, and sell a call option with a strike price that is higher than the current price. This is how the strategy works. As a result of selling the call, you are entitled to the premium, which you retain regardless of the movement of securities. When to use it? Use this if you are willing to sell your shares at a specific price or if you want to make revenue to protect yourself against the possibility of a decrease in the price of your shares. In the event that Microsoft is currently trading at $330, for instance, you may sell a call option with a strike price of $350. You are required to sell Microsoft shares if the price of the stock climbs above $350. However, if the price stays below $350, you are allowed to keep the premium and continue to hold the shares. Collars. A protective put and a covered call are both components of the collar strategy, which is a type of option strategy. It offers a well-rounded strategy, minimizing both the potential for gain and loss while simultaneously lowering the overall cost of protection. The way it works is that you hold shares in an artificial intelligence stock, purchase a put option at a price lower than the current price, and then sell a call option at a price higher than the current price. As a result of the premium from the call helping to offset the cost of the put, this hedge is considered to be financially efficient. When you are unsure about the volatility of AI stocks and want a fixed range for losses and gains, collars are a good tool to have at your disposal. Example, you hold shares of Palantir PLTR, which are currently trading at $20 a share. You purchase a put option for $15 and sell a call option for $25. Your losses will be offset by the put if the price falls below $15. However, if it climbs over $25, you will be required to sell the shares, but you will be able to keep the call premium and lock in your winning. Long put spread is the fourth option. To engage in a long put spread, also known as a bear put spread, one must first purchase a put at a particular strike price and then sell another put at a lower strike price. When compared to a single protected put, this method not only reduces the cost but also reduces the amount of losses that can occur in the event of a downturn. The process involves purchasing a put option at a higher strike price and then selling a put option at a lower strike price. This is how it makes sense. Because of this, the maximum loss and maximum gain are both capped, which results in a more cost-effective method of hedging. When to use it? If you are looking for cost-effective protection and foresee a moderate decrease in AI stocks, you should think about using a long put spread investment strategy. Consider the following scenario. You hold shares of Alphabet GOGL that are now trading at $140. You could buy a put option with a strike price of $130 and sell a put option with a strike price of $120. The cost of the hedge is reduced while your loss is limited thanks to this configuration. Considerations regarding timing and timing. It is vital to do the following before putting any option strategy into action. Analyze current valuations, the sentiment of the media, and the fundamentals of the company to evaluate market sentiment and valuations. The use of technical indicators such as moving averages, relative strength index RSI, and volatility indexes can assist in determining whether artificial intelligence AI stocks are overbought or oversold. Stock prices can be influenced by a variety of factors, including regulatory announcements, technological advancements, and rivalry in the field of artificial intelligence. This is especially true for companies that are in high-growth yet speculative stages of development. Asterisk concluding remarks. The euphoria surrounding artificial intelligence equities may have created valuations that are not sustainable, even though AI is producing extraordinary improvements and revolutionizing sectors. Utilizing properly selected options techniques such as protected puts, covered calls, collars, and long put spreads, investors can safeguard themselves against the possibility of an artificial intelligence bubble. If the artificial intelligence bubble does burst, you will be well prepared thanks to these strategies, which assist reduce risk and preserve rewards. You will be able to successfully traverse the uncertain future of artificial intelligence if you incorporate options as part of your risk management approach. This will allow you to strike a balance between the potential for profit and appropriate protection. Enjoy the content? Don't forget to like, subscribe, and hit the bell icon for more updates. Drop a comment below. We'd love to hear from you.